Welcome back. My name is Arya and I don't waste your time, so let's get straight into it. If I asked you to list off what you believe are the most valuable brands on earth today, it would be a very short list before you arrive at Nike Corporation. One of the great American entrepreneurship stories that seems like they have a Avengers team worth of professional athletes contractually obligated to wear their clothing. You have the likes of Michael Jordan, Kobe Bryant, LeBron James, and we're not exclusive to basketball players here. We have the greatest golf player of all time in Tiger Woods, Cristiano Ronaldo, and the list goes on. They have hundreds and hundreds of professional athletes. And ultimately, their brand value is unlike any other in their respective industry. But ladies and gentlemen, even Nike, with all their greatness and all their athletes, has began to falter in the past couple years. So in today's video, we look to try to shine some light on the situation with Nike. Is it a stock that is worthy of your investment dollars, or is this simply yet another retail stock falling as a result of the softening consumer? And at the end of it all, of course, we're going to highlight the risk factors, because that's something that I personally think a lot of people kind of brush off and don't really go into detail to try to see whether or not they're comfortable with that company in specific. Without further ado, and I want to highlight the stock price here, and of course, it is an output measure, and so this doesn't directly correlate with the actual issues that are going on in the business, but I think it's a pretty big deal if your stock is down in the past 5 years. It either means A, the stock was super overvalued, and so sure, the company itself is growing fine, but the stock itself is readjusting because of the expensive valuation 5 years ago, or B, there's actually something underlying going on with the business that has led to roughly 110% underperformance to the S&P 500. If we zoom in from the all-time high, it looks even worse. The stock is down roughly 50% since the all-time high back here in November of 2021, so just about 3 years. And in order to figure out what is actually going on with this business, I look at the Morningstar report. They're able to kind of nail it down to a handful of different issues with this business. First and foremost, Nike struggled with supply chain problems and excess inventory in the 2021 to 22 period, but has made good progress on fixing these issues. A little bit further down here, they mentioned what we just talked about. Nike is vulnerable to weakness in US physical retail. Department stores that carry its products have been downsizing and cutting orders. However, the firm should be able to make up for slowness in some areas of retail through direct-to-consumer sales. And I think that's something very important that was just said right there, is a softer economy in the US in particular, because that's where they drive most of their revenues. That's going to directly affect a business like Nike that sells premium athleisure products that are priced a little bit above what discount options from just maybe getting something from Walmart would look like. And additionally, if their inventories are sitting for extended periods of time, department stores and stuff, they're going to be discounting those just to kind of get rid of the inventory, because it would be more costly to have that inventory sit there than it is to offer, say, a 10-15% discount to get rid of it. There's some interesting things that happen there with perhaps the deterioration of the brand. If you're able to pick up, for example, Air Forces 20% under what they're supposed to retail for, maybe it gives you an idea that that brand is worth a little bit less. But anyways, that would have to happen for multiple years, but nonetheless something to maybe think of in the back of your head. Morningstar does say that the direct-to-consumer sales, which is something that Nike in recent years has gone very heavy into, they really are pushing their own website and their own stores, really trying to cut out the retailers and department stores in the middle there. This should be able to alleviate some of the issues with the department store side of things. Now, the big risk factor that I see get tossed around all over the place on Twitter and that type of stuff is the increased competition in this category. Of course, Lululemon has been a business that has been competing head-to-head with Nike, actually pricing above in some cases. But in a second here, I'm going to demonstrate to you why actually Lululemon in particular, while it does have some overlap with Nike, it's not much. But the bigger category, which is more important to Nike, is in fact the running shoes category. And so you might have heard, particularly On Run and Hoka One, which I've personally never actually seen. These are two shoe brands that are new to the scene and gaining massive market share against Nike. Morningstar notes here that Nike is under constant pressure to release new products that resonate with consumers and may miss sales projections if it fails to do so. And so the risk that we see here is that Nike is, at the end of the day, under pressure by these newcomers in the industry to be able to make shoes that are appealing to the ever-changing appetite of the consumer. And so at the end of the day, like, this is actually probably the biggest risk factor, is what I like to call the TikTokification of retail, where, like, for example, Crumble Cookie is a perfect example of this. Because of how viral it has gone on TikTok, people are lining up quite literally around the building just to get $6-7 cookies. And so you could see this on maybe a little bit of a smaller scale with On Run and Hoka and some of the other brands, or even in the makeup world, something like Elf Beauty. Elf Beauty has gone, again, hyper viral on TikTok, driving massive, massive demand for their products. And a lot of people are exposed to their products, and that has resulted in kind of some market share taking with Estee Lauder products, right? So an interesting story there. Maybe we'll cover it on the channel next time. And so jumping over to FinChat, I've already loaded in Nike here. And before we really go deep into the EPS and the total revenues and that type of stuff, I want to just demonstrate like where is the revenue of this business coming from? Particularly, like what are they selling exactly? And we could do this because FinChat has a bunch of different KPIs on thousands and thousands of stocks. And so if we kind of put it in like a stacked view, we're able to see that first and foremost, this global brand division's revenue, I can't even see it. It's so small. So honestly, I'm gonna just get rid of that. But you can see there's really 4 main segments with Nike. And over here in the blue, overwhelmingly, we could see that the footwear revenue of this business accounts for what seems like about 60% of total revenues. That's followed up by around 13 billion in apparel revenue, so the clothing side of the business. That seems to account for about 26% of total revenues, and then all the way at the bottom at roughly about 4% each is equipment revenue and Converse. And I don't know if you guys know, but they actually own Converse, like the shoe brand. And so with that being said, you kind of get an idea of when I mentioned earlier that like Lululemon doesn't exactly compete with them in the biggest, most important category, which is their footwear. This is what I mean. And then on top of that, like I would assume most of Lululemon's customers are women. And so that's like even a smaller fraction of the footwear. So like overlap at the end of the day, call it about like 15% between Lulu and Thing. Of course, Lulu is getting into the footwear business, and I haven't heard too much about that, but I would assume, again, increased competition for Nike. And then another chart that I wanted to go ahead and demonstrate here is where the revenues are coming from by geography. And so again, if we go and toggle on in the segment and KPI section, we're able to see that there's a pretty even distribution across the major geographies. Of course, North America stands as by far the most important, followed by Europe, Middle East, and Africa, Greater China in the green, and Asia Pacific, Latin America in the red, all the way at the bottom there, right? A key thing that I want to highlight here is that only about 15% of Nike's revenues come from China. Compare this to something like Starbucks, where I can't remember the exact number, but like 30-40% of incremental growth is purely coming from China. Of course, that's incremental growth, so slightly different, but nonetheless, the point still stands. That is a business that is highly reliant on China compared to Nike, which 65% reliant on Europe and North America. So these are more established geographies with more discretionary income. In the call it next 5 to 10 years, I think that should result in less volatility when it comes to their earnings. And so, ladies and gentlemen, the big thesis with Nike, there's many problems with it. They had inventory issues. They're going to have inventory issues in the future. There's a massive, massive amount of competition with even players like Lululemon stepping into their aisle. Their revenues, as we just saw a second ago, is actually declining on a year-on-year basis. There's many issues with Nike. There's no doubting that. But at the same time, I'd like to highlight that Nike is trading at a valuation that hasn't been seen since the COVID crash and the 2017-18 trade wars crash earlier in the decade. So we've seen only 2 other times where Nike has traded at the current valuation it trades at, roughly the 2.5 times price to sales. And I went ahead and I looked at every single time that this has happened, and you would see that in the ensuing year, on the first time that this happened, Nike's stock went up by 71%. And the second time, of course, it was a COVID rally and all that type of stuff. The stock had gone up 115%. Of course, past performance is absolutely not indicative of future results in this case, this time around. But the point still stands. Nike has slid into, at least on a price to sales basis, they've slid into territory that hasn't been seen in multiple years. And the world was shutting down the last time this happened. So again, ask yourself, the sentiment towards Nike at the moment, given the price to sales valuation, is so bad that in theory, it's equivalent to when the world was shutting down and Nike wasn't able to have people come into stores to buy their products. I think our situation at the moment is just a tad bit better than, 4 years ago. So of course, I really do want to nail this point in. It's absolutely not perfect with Nike. And something that I personally look for in businesses is that they're able to consistently grow their revenues, their bottom line, all that type of stuff. And in the case of Nike, we're seeing actually a deceleration and a decline as of the past couple quarters. This is not what I like to see with the businesses that I like to buy. And if I were to personally consider this in my portfolio, it would be an atypical kind of turnaround value play, and I'm not too good at picking those companies. But if we look historically to just, for example, the revenue growth of Nike, we could see that there has been periods of multiple years of stagnation, followed by Nike figures it out, and then they're off to the races. And then, of course, you have the 2020 crash that we just mentioned, where revenue declined year on year, and then they figured it out from there. So is 2024 the next mini slowdown in this repeating cycle? I don't know. Nobody knows. But given the sentiment around the company and how cheap the valuation actually is, I would be inclined to say that even at a very small portfolio allocation, this is an incredible risk to reward trade. And I'm being careful with my words here. It would in fact be a trade if one were to buy into the company at these valuations. Now, before we move on here, I want to just talk about one other thing before I know I'm going to get comments about it. A lot of people are going to say, oh, but the PE is only, in the low 20s, whatever. On a bottom line basis, it's not even that cheap. Google's cheaper, whatever. My argument back to you would be that this business is not currently optimized for earnings. And it's kind of funny to say, but they literally aren't. They've come off of a peak of roughly 13% net income margins all the way down to 10-ish%, a little bit recovering in the past couple quarters. But as it stands currently, Nike isn't optimized for profitability. And so the shares on an earnings basis look a little bit more expensive than they actually might be if Nike were to recover their net income margins. Hence why earlier in the video, we were looking at it on a price to sales basis, not necessarily a price to earnings. And by the way, if you've been wondering this whole time, what is this incredible software, Arya, you're using to put up all these different charts? This is finchat.io. If you use the link in the description, you could use it completely for free, but the version of the software you're looking at in front of you is full functionality, which you could get like a 2-week free trial for. Anyways, to kind of wrap it up here, I want to go through Morningstar's fair value and profit drivers segment. I think they do incredible analysis on this part of the report. Long story short, they just go through what the numbers currently look like at Nike and what they expect and are projecting in the future, and they're able to derive you a fair value based off of that. So in the case of Nike here, they say, despite the anticipated sales decline in 2025, we forecast compound average sales growth for Nike to be 5% over the next 10 years. Of course, it's a decently mature and slow-growing business, so that shouldn't surprise anyone. We expect it will achieve compound annual revenue growth of 2% in North America, perhaps slightly below expected market growth. We think Nike's innovative products and e-commerce will allow it to hold its market position and premium pricing, but we acknowledge that the market has become very competitive. And so again, this speaks to the competitive issues that they're facing over at Nike, but they note that they're going to be able to maintain their market share and slightly grow in the North American market. In Greater China, its fastest growing segment prior to the recent challenges, we expect compound average growth of 11% over the next decade. So I'm going to eat my words here. I did mention the thing about Starbucks and China not being too important. It seems that China is going to be a very important geography for Nike in the future. In this little paragraph here, they say that the gross margins were just shy of 45%. They expect it will increase to just shy of 50% in the next 10 years, which honestly, pretty good gross margins for an apparel business. And so to kind of give you a high-level summary of what we just went through, it's a business that is facing a lot of challenges, no doubt about that. But at the end of the day, this is a business that has contractual obligations with hundreds and hundreds of professional athletes, and they have history with athletes that have, in some cases, Michael Jordan, he's retired 20, 25 years ago. Or in the case of Kobe Bryant, God rest his soul, he's passed away. So you're not going to go back and get these athletes in their prime and build that brand value. And the dunk of Michael Jordan with the Nike swoosh on his foot. These are irreplaceable. These things have no value. And so at the end of the day, sure, there's a lot of challenges. Sure, it's a slow growing business. The margins are under impact. They have inventory issues. There's many, many things wrong with Nike, and it looks extremely gloomy. But at the end of the day, at its core, you have an incredible one-of-a-kind asset, and that is, of course, the brand. And I'm borrowing from the Acquired podcast here, but I think similar to the Hermes and Louis Vuittons of the world, I think Nike would have to be a bad brand, would have to be a sucky brand for probably the entire duration of a human growing up and becoming an adult and going into their 30s and having kids. For that entire duration, so call it maybe 30, 35 years, Nike would have to be a terrible brand so that growing up all their life, Nike has been a terrible brand in order for this brand value to actually deteriorate. I think you could even give it another 10 years of missteps and inventory management issues and just everything. Their market share getting taken. You could have another decade and Nike would probably still come out the other side with minimal scratches on their brand value. And with that, I suggest you subscribe to the channel because I'm the only finance creator on YouTube that doesn't waste your time. There's a reason I only have one sponsorship on the channel, and I've been using that since before I was even affiliated with them, which you can check by going back 6 months in my YouTube videos. With that being said, thank you very much for watching. Check out FinChat with the top link in the description, and have a great day.